The committee will now come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled Stress Testing: What's Inside the Black Box? Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. When done right, stress testing can be beneficial to banks, consumers, and the financial system. Stress tests demonstrate to everyone that the U.S.'s largest banks are well capitalized, resilient, and capable of functioning and lending throughout the economic cycle. But for all these benefits to flow from stress tests, the tests must be credible, with transparency and accountability. Instead of running stress tests in an open and accountable manner, subject to public scrutiny, the Federal Reserve cloaks the stress tests under a veil of secrecy. This is no legal basis for this secrecy, and the perceived benefits of secrecy are illusory at best. No one disputes that the stress tests are used in binding capital requirements, including the stress capital buffer, and can be used to restrict banks from paying dividends. The stress tests, including the scenarios and models, must be subject to the notice and comment rulemaking process. I'm certain that we'll hear from our colleagues on the other side of the aisle that key aspects of stress tests must remain secret and not subject to public comment. We'll probably hear that banks will simply, quote, game the tests, and that there is not enough time to take public comment on stress test scenarios. Even if these arguments were legally tenable, which they are not, they still don't carry water. As we'll hear from our witnesses, it's not clear that the banks could easily game the stress tests, even if they wanted to. And the Fed already has plenty of traditional supervisory tools to address gaming. More importantly, if disclosing models resulted in better stress performance without improved risk profiles, this suggests there are material weaknesses in the models themselves rather than a problem with public disclosure. It's critical that the Fed gets stress testing right. And with growing politicization of the federal banking agencies, it is possible that rogue officials pursuing political agendas could also game the tests by manipulating models and assumptions to obtain desired results for heightened capital requirements or reduced dividends. The stress tests have real-world impacts. Banks make capital allocations based on how they think they will perform on stress tests. This means that banks are making decisions about how to lend based in part on how they think the Fed's models will work. And that has massive ramifications for the real economy. And because banks are only making guesses, they must be more conservative with how they allocate their capital to ensure that they can easily pass the stress tests regardless of the underlying models and assumptions used. Again, this has real-world impact on the families, farmers, and small businesses who rely on banks to access credit. Moreover, the stress tests impact how much dividends banks can pay. It's important that banks can return their profits to shareholders, as otherwise investors will not choose to invest in banks in the future. This hearing builds on the work that our committee has been doing in this Congress to improve the stress testing regime. This committee recently reported out my bill, the Bank Resilience and Regulatory Improvement Act, which would require that the Fed disclose the underlying models and assumptions used in the stress tests and require that the Fed take public comment on each year's stress testing scenarios. Of course, there's nothing keeping the Fed from fixing these problems on their own, but due to their continued unwillingness to do so, I applaud my colleagues for advancing this important piece of legislation. One final note, we have to also recognize and remember that stress testing and the way in which stress tests are conducted interface with the existing regulatory regimes that are out there. And so as the banking agencies are reviewing the proposal on Basel III Endgame, we must keep in mind how that can work cumulatively with any changes to stress tests. Also, the long-term debt rule. These requirements can pile up, and the way in which they work and are interchangeable is very, very important. And so there is interplay among these regulatory and administrative decisions. So I look forward to our witnesses and their testimony and shedding at least a glimmer of light on these opaque processes. And with that, I now recognize the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois, Dr. Foster, for 4 minutes for an opening statement.
Thank you, Chairman Barr, and thank you to our witnesses for joining us, particularly those of you who spent part of your lives trying to understand what befell our economy in 2008 and how to keep it from happening again. You know, in 2008, during the crisis, large U.S. banks faced a crisis of confidence, and as the economic conditions continued to deteriorate, and the question came up just, you know, how much worse things could get. And the outlook was dim at best, and action was needed to assure investors and the public that U.S. banks were capable of withstanding, continued negative conditions in our economy. So in 2009, regulators conducted simultaneous stress tests of the 19 large U.S. banks to project their ability to continue should leading economic indicators continue to go downhill. And by publishing the results of the stress test and requiring banks to correct capital deficiencies, these stress tests were a big part of what restored confidence in large U.S. banks, and that they would be able to continue serving Americans if the crisis were to continue to worsen. And this process, viewed almost universally as a success, led to the creation of the permanent stress testing regime that we now know today, with Congress requiring regular internal and supervisory stress testing of large banks as part of the Dodd-Frank Act. But as stress testing has evolved, industry participants have petitioned for greater transparency and predictability of stress tests from regulators, which has its pros and cons, which I hope we're going to have a thoughtful discussion of this in this hearing. Under the last administration, the Federal Reserve began publishing significantly more details regarding the design of stress test models and their methodology, including projected loss rates for certain types of loans. But despite the added transparency, industry participants and others have continued to advocate for closer to total transparency of stress test scenarios and models, both afterwards and even prior to the stress test. So academics and former Federal Reserve officials rightly cautioned against this approach of total transparency, raising concerns that too much transparency in stress testing would allow financial institutions to game the stress test in various ways. When I first heard about the concept of stress tests back in 2009, I thought, oh, that was a good idea, and I was impressed at how it worked. But I was also warned at the time that it is not a panacea. History gives us examples of the weaknesses of fully transparent stress tests. One relevant to this discussion is in 2002, the Office of Financial Housing Enterprise Oversight administered what they called stress tests to Fannie Mae and Freddie Mac, which they passed and which were not really viewed as a success in terms of diagnosing real problems they had. The agency did disclose all the comprehensive details about their stress testing model, including the scenarios, empirical specifications, and parameter estimates for public notice and comment. I don't think anyone or very few people appreciated not only the fragility of asset valuations there, but the correlations in those asset valuations. No one could anticipate, for example, that you'd have a nationwide drop in housing prices. And it wasn't reflected in the risks that the market priced into various complex financial devices that were put on as a layer on top of housing finance. And so complete transparency and limitations on the agency's ability to update the model to reflect changing economic conditions reduce the efficiencies of those tests, and we have to avoid that mistake here. And in retrospect, the academic community has noted that these factors provide a very poor window into enterprises' true risk exposures. And so like I say, I hope for a really thoughtful discussion of the pros and cons of different kinds of transparency here. And yield back.
The gentleman yields back. Thank you. Today we welcome the testimony of Sean Campbell. Mr. Campbell is the Chief Economist and Head of Policy Research at the Financial Services Forum. Francisco Covas. Mr. Covas is Executive Vice President and Head of Research at the Bank Policy Institute. Jonathan Gould. Mr. Gould is a partner at the Jones Day Law Firm. Greg Feldberg. Mr. Feldberg is a research director and research scholar and lecturer at Yale University. We thank each of you for taking time to be here today. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Campbell, you are now recognized for 5 minutes to give your oral remarks.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, my name is Sean Campbell, and I am the Chief Economist at the Financial Services Forum, which represents the 8 globally systemically important banks, or GSIBs, headquartered in the United States. I'm a PhD economist with nearly 14 years of experience at the Federal Reserve, where I was deeply involved in regulatory policies and stress testing development critical to the stability of the U.S. financial system, particularly following the 2008 financial crisis. The Forum appreciates the opportunity to testify today. Over the last 15 years, U.S. GSIBs have demonstrated their strength and resilience through rigorous and dynamic annual stress tests, holding significantly more capital compared to stress losses, even under severe economic scenarios. Additionally, U.S. GSIBs demonstrated their strength during recent real-life stress tests, supporting the economy during the COVID-19 pandemic and fostering financial stability during recent regional bank failures. An open and transparent regulatory process is a long-standing and well-accepted principle of good governance that provides the public with important information while also helping to ensure the public accountability of regulators. The stress testing framework, however, lacks transparency compared to other regulatory measures, like the risk-based capital requirements that are currently undergoing a public and transparent notice and comment process. Stress test opacity limits public understanding and hinders the broader discussion necessary to improve the stress testing process and mitigate any negative side effects for the broader economy. Transparency is essential to promoting an effective and efficient banking system. Importantly, available research indicates that stress tests have clear impacts on credit allocation in the U.S. economy, and in some instances can lead to reduced lending in areas such as small business and healthcare. As is the case for all other risk-based capital requirements, banks need to understand the regulatory rules to which they are subject to make informed decisions. Stress testing opacity forces banks to make decisions based on incomplete data and information that hinders banks' core function of stewarding financial resources to their most productive and efficient use. Greater transparency in stress testing would improve bank risk management and capital planning, while allowing for more informed assessments by people across the economy of its impact on credit availability and facilitating greater economic growth. To be sure, the Federal Reserve does provide some limited disclosures to the public. The provided disclosures, however, are generally broad and high level, without providing the type of pertinent information that would admit a serious and critical assessment of the stress tests. As an example, in describing its model for net income, the Federal Reserve discloses that, and here I'm quoting from the Federal Reserve's public website, the specific macroeconomic variables that enter each regression model differ across equations and are chosen based on statistical predictive power and economic theory. To analogize, this is a bit like asking your grandmother for her secret chocolate cake recipe and being told, oh dear, it's so simple. Just mix some flour, eggs, butter, and other flavorings together, and there you have it. Stress testing is the only major prudential requirement that does not provide the public with an open and transparent process. This lack of transparency is largely a vestige of the rapid approach that was taken to executing the initial round of stress tests in the midst of the financial crisis. Then, the need to quickly assure the public of bank strength and financial stability arguably outweighed the need for transparency. 15 years on, there is no compelling public policy rationale to maintain a largely opaque approach to stress testing. Today's approach should be broadly consistent with the public notice and comment standards applied to the rest of the bank regulatory framework, which includes Basel III, the GSIB capital surcharge, and liquidity standards. And critically important is the fact that the results of the stress tests now feed into the annual stress capital buffers for each firm, functioning as a de facto regulatory requirement by directly augmenting required capital amounts and, in turn, the allocation of capital to individuals, companies, and important sectors of the economy. In conclusion, greater transparency in stress testing is essential to achieving a more effective, efficient, and resilient financial system. Remedies that should be part of a broader public policy discussion should include 1, more formal engagement with the public on setting hypothetical scenarios so regulators can gain insight to salient risks from a diverse set of viewpoints. 2, requiring that stress test models be subject to the usual notice and comment process that applies broadly to other prudential requirements. And 3, requiring that the stress testing process be subject to a rigorous external audit that would make its findings known to the board and to the public to instill further confidence in the validity and robustness of the stress testing regime. Overall, aligning stress tests with the public process afforded other bank regulatory standards would help improve public trust, promote economic stability, and ensure that banks can support the economy to their fullest potential. Thank you, and I appreciate your question.
Gentleman's time has expired. Mr. Covas is now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, and Subcommittee members, thank you for the opportunity to testify today. My name is Francisco Covas, Head of Research at the Bank Policy Institute. We are a research and advocacy group supported by banks with over $100 billion in assets. Our membership spans the full range of banks under the Federal Reserve stress tests, so we are keen to testify today. The stress testing regime that underpins the capital framework for large banks consistently demonstrate that U.S. banks are well capitalized and can continue to support the economy during economic downturns. Since 2020, stress test results have been used to set a stress capital charge, effectively part of large banks' minimum capital requirements. We support using a stress capital buffer in overall capital requirements. However, the lack of transparency in the Federal Reserve stress testing regime has significant economic costs that can adversely affect U.S. financial system and the broader economy. The opacity and inaccuracy of the Fed's models create uncertainty for banks about the level of capital they are required to hold, leading to excess uncertainty buffers that reduce credit availability and decrease market liquidity. In my written testimony, I provide several examples that highlight the inaccuracies and the volatility inherent in the supervisory stress testing models used to determine the stress capital buffer. Year after year, we observe significant fluctuations in the stress capital buffer that often fail to reflect actual changes in banks' risk profiles. This disconnect can be attributed to various factors. First, the lack of granularity in the Fed's revenue projections, which are prone to inaccuracies and volatility. Second, the Fed's models consistently underestimate trading revenues during times of higher market volatility, a finding that runs counter to historical experience. Third, operational risk loss models have proven to be inaccurate, with projected losses increasing in the post-pandemic period despite the absence of a corresponding rise in real-world losses. Fourth, loan loss models also tend to overestimate losses compared to banks' internal projections, likely due to the Fed's inability to properly account for bank-specific factors. Fifth, compounding these issues is a flawed reconsideration process for appealing stress test results, which suffers from a lack of independence and transparency. It is also important to have notice and comment on the scenarios used to calculate the stress capital buffer. Our analysis reveals that the 2024 stress scenarios diverge significantly from historical experience and the Fed's own guidance. Several macroeconomic variables in these scenarios are dramatically more severe than those observed in previous U.S. recessions. Consider this example. In just the first quarter of the stress planning period, the severely adverse scenario in this year's stress tests assumes a decline in the house price index exceeding 15%, and this is not annualized. This projection far exceeds what we observed during the 2007-09 global financial crisis. Such an extreme scenario implies unprecedented shifts in other macroeconomic variables, including sharper initial increases in unemployment rate and steeper declines in short-term rates. The result? Financial institutions face considerably higher projected losses and lower revenues compared to prior severe recessions. Moreover, the calibration of the global market shock component that applies to the largest banks has become less transparent over time, so it isn't clear what scenario the GMS currently represents. In summary, increased transparency in the Fed's stress testing regime is necessary to reduce uncertainty and promote a more efficient financial system. U.S. banks are very well capitalized, but the current stress capital buffer framework suffers from excessive volatility, inaccurate projections, and a flawed reconsideration process, leading to less lending and increased market liquidity. Moreover, the stress scenarios violate the Fed's own guidance and are significantly more severe than historical recessions. Allowing public comment on scenarios and supervisory models would enable extensive review by experts, academics, and banks. This would increase transparency in scenario design and improve model accuracy, fostering a more effective financial system that better serves the U.S. economy's needs. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you. And now, Mr. Gould, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to discuss stress testing. My testimony is my own. I'm speaking today solely in my personal capacity. I'm not speaking on behalf of any clients or my law firm. Stress testing has transformed bank capital from a backward-looking static concept into a forward-looking dynamic requirement. But its current integration into the overall capital framework rests uneasily with the requirements of administrative law, and agency overemphasis on regulatory capital as the primary supervisory tool risks marginalizing the important role of examination in ensuring the safety and soundness of banks. The modern form of supervisory stress testing traces its roots to the 2008 financial crisis. To restore confidence in the health of the largest bank holding companies, the federal government designed and administered the Supervisory Capital Assessment Program, or SCAP. Under this program, regulators assessed whether banks would remain well capitalized in an adverse macroeconomic scenario. The SCAP was widely viewed as a success. But like many crisis-era actions, legal authorities and process were not scrutinized too closely given the exigencies of the moment. Congress subsequently endorsed and ratified the concept of supervisory stress testing in the Dodd-Frank Act the following year. But like other extraordinary programs born of the crisis, supervisory stress testing has evolved into something more. As the Fed embarked on the creation of its Comprehensive Capital Adequacy Review, or CCAR, it melded regulatory capital, stress testing, and capital planning into an omnibus framework, part supervisory exercise and part regulatory requirement, making liberal use of guidance to knit the new edifice together. Supervisory stress testing became a cornerstone of a new approach to regulation and supervision of the nation's largest financial institutions. In and of itself, supervisory stress testing would be merely hortatory and at critical times illuminating for regulators, markets, and the banks themselves. But under the Fed's hybrid framework, supervisory stress testing is also used to limit capital distributions and has now become the means for setting binding capital requirements for large banks through the introduction of the stress capital buffer. The Fed's continuing failure to seek public comment on its stress models and scenarios, and in the case of the former, even disclose them at all, raises significant concerns under basic principles of administrative law. First, the Administrative Procedure Act requires agencies to pursue legislative rules through notice and comment rulemaking, but the Fed has not sought public comment on its models and scenarios. In the case of the stress capital buffer and planned capital distributions, its related rulemakings are, at best, incomplete, omitting the most critical components. These omissions are particularly egregious since they not only inform but dictate what is arguably the most important regulatory requirement on banks, their capital levels. Nor is this an area of legal ambiguity or first impression. Courts have repeatedly held that models treated by agencies as binding must go through public comment. Second, because the Fed's models and assumptions are the basis for its actions, and it has not disclosed its models, it is unable to explain its decision-making process. As a result, its actions appear arbitrary and capricious. At its core, the Fed has created a framework that allows it discretion to set capital levels for banks through scenario choice and model design with limited accountability. Its only constraint is the models themselves, but the public lacks visibility into these models as well as their design, backtesting, and revision. Put another way, the Fed's capital stress buffer is like a highway with an unposted speed limit that changes on a regular basis, and one only learns the speed limit after being pulled over. Whatever the value of stress testing, its utility is no substitute for its legality. Supervisory stress testing and the capital edifice it supports are the paradigmatic post-2008 reforms. But this new approach to regulation and supervision is too often marked by its complexity, opacity, and only episodic adherence to basic principles of administrative law. As federal banking agencies appear poised to double down in these and other areas, Congress should ensure the agencies abide by applicable legal requirements and assess the effectiveness and costs of current post-2008 regulatory reforms before expanding them. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you for your testimony. Now, Mr. Feldberg, you are now recognized for 5 minutes.
Chairman Barr, Ranking Member Foster, members of the subcommittee, thank you for the opportunity to testify. Stress tests have played an important role in our financial history. Along with two of my fellow panelists today, I was involved in the first stress test on the staff of the Federal Reserve, and I think we're all very proud of how that turned out in 2009. I would like to make 4 points about the state of stress testing today. First, supervisory stress tests should be countercyclical. Stress tests should help supervisors keep their guard up during those long periods of financial calm when the possibility of a banking crisis and its associated costs appear remote. In good times, stress tests should be tougher, and we should resist the inevitable pressures to reduce the rigor of the process. Second, stress tests should use multiple scenarios. Financial crises tend to come from unexpected places. The Bank of England and European Central Bank have long used exploratory scenarios every other year. They are not binding. They simply help the understanding of regulators and the banking system about the risks out there. For the first time this year, the Federal Reserve has introduced non-binding exploratory scenarios, and I welcome that development. But in short, the US innovated the use of supervisory stress tests during the crisis in 2008. Early efforts in other jurisdictions didn't measure up, as they learned in other jurisdictions, to ours. But in later years, the innovation has been elsewhere in other countries. Third, stress tests are part of a broader regulatory and supervisory toolkit. Some have argued that the Fed's stress test should have included Silicon Valley Bank, the first large bank to fail last year, and a rising interest rate scenario. I'm not sure that would have worked. It's possible that rising rates could have boosted net interest income in the test, making up for the decline in asset values. The International Monetary Fund actually made that very point in 2020 in commenting to the US about its financial stability system. The IMF recommended instead that the US implement an existing Basel standard for interest rate risk management with quantitative thresholds, as many other countries have done. I made that argument last year in a blog. There's no doubt that Silicon Valley would have failed on the Basel interest rate risk test. The lesson is that supervisors need many tools in their toolkit. The lesson was, that was again driven home recently when supervisors rejected several big banks' resolution plans. But I guess the main topic of this hearing, and fourth, transparency can be a double-edged sword. As I noted in a paper in 2019, the goal should be to reveal just enough about the Fed's methods to help banks develop their models and manage their risks, but not so much that it becomes a predictable compliance exercise, which was what it really would become if Grandma showed you her recipe, like Sean said. I'll make two observations about that trade-off. First, we are already revealing a lot to the regulated industry, which may allow them to merely optimize to the test. After what you've heard today, you may be surprised at how much we reveal in the US. I refer everyone on the committee to review the Fed's public methodology and scenario documents. You might be surprised at the level of detail after what you've heard today. You'll see 50 pages describing the models, including descriptions of inputs and equations, 26 pages on loss rates. I had a colleague on my team look at other jurisdictions to see what they revealed. The US was far ahead of other countries, except Bank of England to some extent, and he couldn't find another country that revealed its loss rates. So you might wonder what it is we'd like to be more, we're hearing we'd like to be more transparent about from the folks here today. Sean Campbell, his testimony, his written testimony, was very helpful in understanding what it is we're being asked of. And his testimony is fairly long. I think the main thing he's asking for is, gosh, we do get a lot of information about the models. We do get a lot of information about loss rates, but we're missing the parameters. Just tell us the parameters and we'll really be able to make grandma's cake. And I think at some point that becomes no longer a supervisory test, but something that lacks any kind of impact. We have a good example of what happens when you put the parameters of a stress test out for public comment, like what's being proposed today. The supervisor of the government-sponsored enterprises, Fannie Mae and Freddie Mac, were subject to congressionally mandated stress tests from 2002 to 2008, which did not detect any risks. In fact, they showed strong compliance. Why? It turns out the supervisor, OFAO, never tweaked its models, despite growing obvious risks in the mortgage market. One paper found that the requirements to publish all stress scenarios, empirical specifications, and parameter estimates in the Federal Register meant that it would have been administratively cumbersome to make any material changes to the underlying models. In short, supervisory stress tests are very important for bank risk management. I'm concerned, as are many others, that the tests have become too routinized and that further disclosures from regulators will simply make them more so.
Thank you for your testimony. We'll now turn to member questions, and the chair now recognizes himself for 5 minutes for questioning. We'll start with Mr. Gould. Will you please explain why it is legally problematic for the Fed to keep secret the stress test models and methodologies?
Thank you, Mr. Chairman. Because the models and scenarios that the Fed is using, and at least with respect to the models not disclosing, are not put out for public comment, And because the Fed relies upon those models and scenarios to essentially calculate the stress capital buffer, which is a binding constraint on banks' capital, those models and scenarios are essentially legislative rules, and under the Administrative Procedure Act, they have to go through public notice and comment rulemaking.
And are there also legal problems with the fact that the Fed does not give the public any opportunity to comment on the scenarios used in the tests?
Well, yes, public comment is a requirement under the APA for legislative rules. So yes, that is a problem as well.
And could public comment improve not only the process, but the tests themselves?
Yeah, so setting aside the legal requirement that they have to do this from a policy standpoint, yes, it could inform it. In fact, that's the entire rationale behind public comment generally. It is to inform the agency promulgating the rule on how to make the rule better.
Mr. Covas, a number of commenters, including you, have noted the overlap between the stress testing and the Basel III Endgame proposal, as I suggested in my opening comments. Can you talk about how supervisory stress tests already account for market risk and operational risk?
Thank you for the question. Yes, so the Fed projects operational risk losses over the 9 quarters of the stress horizon. That reduces revenues under stress for the banks subject to the stress test. So operational risk is already accounted. For market risk, the Fed, as for the largest banks, subject to the largest banks to the global market shock, for which assumes an instantaneous shock to banks' market positions and results in these significant losses. So operational risk losses account for about 25% of losses of all the banks subject to the stress tests. Market risk losses account for roughly 20% for market risk losses for the largest banks in the stress tests.
And we are told that the Fed is undertaking broad and material changes to the proposal, but if the Basel III Endgame proposal were finalized as it has been proposed, do you think that there would be a double count of these risks, meaning that banks will be required to hold more capital than is necessary to address their market and operational risks?
Yeah, so yes, so basically the Basel III proposal basically doubles capital requirements for operational risk and materially increases capital requirements for market risk. The way the banks allocate capital across business lines, they look at the entire capital requirement, both based on the Basel framework as well as the result of the stress tests. There are significant overlaps because both of the stress losses, operational risk losses, for example, they are stress losses in the stress test by definition. Also under the new Basel framework, that also are considered to be stress losses. They are all calibrated back to the global financial crisis, large mortgage losses that the banks experienced, and they effectively are a double count in the sense that they are requiring banks to hold capital for exactly the same types of risks.
So I think that's very important that the Fed then take into account as they undertake these broad and material changes to Basel III, that they take into account what the stress tests actually require as well, so that there's not double counting. Mr. Campbell, finally, there were numerous concerns expressed on the Basel III Endgame proposal. Fed Chair Powell and Vice Chair Barr have both stated that these comments have been helpful in ensuring proper consideration of the costs and benefits and the expected decrease in availability of credit. It seems to me that the static capital requirements have benefited greatly from transparency and public engagement. At the end of the day, stress tests are essentially dynamic capital requirements, as Mr. Gould pointed out. Is there any reason to think that stress tests wouldn't similarly benefit from transparency and public engagement?
No, I think, in fact, indeed, there's every reason to believe that the stress test would benefit greatly from that kind of public engagement, as evidenced by the Basel III Endgame process. There's been a voluminous amount of comment on those rules in that proposal. Most of the commenters, quite frankly, have been from non-banks, as you indicated. The Federal Reserve, key senior policymakers have indicated that those comments have been broad and helpful and that they will result in broad and material changes. So it's puzzling, quite frankly, to understand why the Federal Reserve wouldn't want to avail itself of the same benefit in the context of.
And finally, Mr. Campbell, can you address this accusation of gaming with transparency?
Sure. So I think gaming is a misnomer, and I think the issue is that banks use information in the regulatory structure and the regulatory architecture to engage in prudent risk management. They look at risk weights. They look at GSIB capital surcharges. All of the facets of the bank regulatory framework are available to them. They can look at those things. They're publicly available because they're in the notice and comment process, and they use that information to engage in prudent risk management. That's no different for stress testing than it would be in the way that firms look at risk weights in the context of Basel III Endgame. They all feed into the total overall capital requirement that applies to the firm, and they use that information.
Thank you. My time has expired. The chair now recognizes the ranking member, Dr. Foster, for 5 minutes.
Thank you, Mr. Chair. One of the defining characteristics of the 2008 crisis was the unanticipated level of interconnection and contagion. And it's hard for me to see how pure capital requirements can pick that up, as well as a stress test. If you think of, the question of AIG when it came out was no one anticipated just how interconnected AIG was and what a body blow it would be to the entire international banking system if AIG went bust. And that became a huge issue when it, in fact, did go bust. Mr. Feldman, can you talk a little bit about how a stress test might be able to go after contagion and interconnectedness in a way that just pure regulatory capital requirements might not?
Sure. I mean, I think the basic innovation of the stress test is the introduction of a severe shock that is imposed on the entire sector, the entire financial sector, to the extent that the shock affects intermediaries, then you're supposed to be catching the impact that would have on banks. I'm not particularly convinced that the AIG scenario would have been caught by the stress test the way they're currently designed. After the global financial crisis, there were many responses of the regulatory community to try to address the AIG incident and to make sure that doesn't happen again, ranging from the way banks manage their risks to the way credit risk transfer and structured credit products are handled in the first place. But I think that the development of the credit risk transfer market in recent years suggests that some of those risks are rising again. And that would be a useful thing to add to the stress test. I'm not sure it was included this year, and I hope they include it next year.
Yeah. And it appears that there's a little talking past each other on what exactly is meant by increased transparency. So radical transparency means that the Fed just publishes all the Python source code for all of its models for all of the, which could be done. But that's only half the problem. If the public is going to understand what's involved, they will also need access to the granular information that you get from banks, which would have huge problems. I doubt that Mr. Campbell, your members, would be enthusiastic about revealing that to the public. And so how do you, it would be so when you're talking about letting the public see this, that the public seems really to be the analyst inside the giant banks rather than the general public. They will be able to see how the details of the model applies to all the private information they hold. And so how do we deal with this if you have a lot more transparency, preventing the public from reverse engineering many of the positions and private information of the large banks? Or generally, how do you deal with that trade-off? Yeah, go ahead, Mr. Campbell. First off, I want to compliment you on your, it took me 2 glasses of wine to get through your written testimony, and it was excellent. Very thoughtful. Thank you.
Great. Now, next time I'll aim for 3 glasses, but thanks very much.
No.
To address your question, so first of all, I think I would say that when we talk about the public, so clearly that includes the banks, so I want to be absolutely transparent about that. So the public includes the banks, but the public also includes not general members of the public, like people like my dad, but people who are, say, economics professors at Stanford University, people who are risk management experts inside the industry, and there are a variety of people in the public that have the wherewithal and the ability to make sense of and understand better disclosures who are not essentially John Q. Public, but who are experts in the field. So those are we should be thinking about those people. Then with respect to your point about the information, so the one thing that I would point out is that the nature of the data that the Federal Reserve collects from the banks in the context of the stress testing process is publicly available through the Y-14 forms. Those forms are on the Federal Reserve's public website. The data is not filled in, but the public has a window into exactly what data is being collected by the Federal Reserve. It has access to the instructions for
But for
filling out
example,
that data.
Mr. Covas was complaining about what appeared to be sort of random jumps in the stress capital buffer. Those could be due to real differences. For example, there was an article in the Wall Street Journal about these synthetic risk transfers. And even though instead of taking it out of the banking system, it had boomeranged back into the banking system. And so that's the sort of thing that should cause a big, if a bank gets involved in that, there should be a big variation in the capital stress buffer if they decide to get involved in that sort of event. The problem is that you're going to have to reveal a lot of details about what the bank's positions really are that caused it to have a big variation in the capital stress buffer. And
Very quickly. So, I mean, I don't think, so a lot of the issues arise on the revenue side. For example, in terms of the volatility you cited, the banks would like to know, or the public would like to know, just which variables are being used, the sensitivities and the coefficients. A lot of the issues are due to the lack of data that the Fed is using, and I think the banks have much more better data and more experience, and that could be dialogue similar to Basel Endgame, where the Fed receives comments from the industry and from subject matter experts that leads to improvement of the models.
I think the gavel is coming down here, but thank you.
Thank you. The gentleman from Florida, Mr. Posey, is now recognized.
Thank you very much, Chairman Barr. Mr. Covas, could you please explain how the lack of transparency in Fed stress models results in uncertainty and impairs the ability of banks to do capital management planning?
Sure. Thank you for your question. So stress test results, the results can change every year, and that affects the capital requirement. It's not uncommon to see increases in capital requirements in excess of 1 percentage point, and the banks have 3 months to comply with the new requirement. So just to give you a contrast, under Basel, the average estimate by the agencies was about 2 percentage points increase in capital requirements, and the banks have 3 years to comply, plus they are subject to notice and comment. So the banks effectively have 3 months to comply with the new requirement, which no bank wants to be inside the buffer when the requirement goes live. Usually the results come at the end of June, go live October 1st. So they have to make significant adjustments to their portfolios if they want to meet the new requirement. So ex ante, in face of this uncertainty, the banks just decide to underinvest in activities that are more cyclically sensitive, namely small businesses and lending to households with less than pristine credit scores. That tend to be the exposures that they tend to economize, and that's how it reduces lending and economic activity.
Okay. You've written on the impact of stress tests on capital requirements and accessibility of credit for small businesses. Could you summarize that research for me?
Sure. So it's basically the fact that small businesses are a highly cyclical sensitivity activity. When you have in the Fed scenarios, assuming an unemployment rate goes from 4% to 10%, the risk of lending to those borrowers increases significantly, and the banks just have to allocate much more capital. So over time, the banks they want to economize capital and assess the return on the investment versus the cost of making such investments. And over time, what we've seen in the data is that the banks, subject to the stress tests, they have moved away from these more cyclically sensitive activities like small business lending.
Thank you. Mr. Campbell, you did research suggesting the Federal Reserve stress models overestimate GDP declines and stress test losses. Could you please explain how the overestimates capital requirements and increases the cost of capital to banks?
Sure. So again, briefly, you're correct that we've done some research at the Financial Services Forum showing that the decline in GDP that you find in the stress test is larger than historical experience. So during the financial crisis, GDP fell about 4%. In the most recent stress test, it fell by 8%, and it kind of bumps around in that general region. And so it is effectively overstated relative to what we've seen in other severe historical recessions. It's also overstated relative to other empirical sort of regularities that relate GDP declines to unemployment. And the obvious impact there is that although we don't know exactly how the stress testing models are put together, real GDP declines are a driver of losses in all of the stress testing models. So whether we're talking about auto loan losses, mortgage losses, business loan losses, a decline in GDP is going to result in those loan losses, and if you ramp up the decline in GDP, you're going to ramp up the loan losses. That's going to make those assets look riskier, maybe riskier than they actually are, given the overstatement in the decline of GDP, and that's going to result in increased capital requirements, which has the natural effect of raising the cost of funding and then incentivizing a pullback in lending to those sectors and to those markets.
Thank you very much, Mr. Campbell. Mr. Chairman, I yield the balance of my time.
The gentleman yields, and will Mr. Campbell please pull the microphone a little closer to you for future testimony? Thanks. The gentleman from California, Mr. Sherman, is now recognized.
It's not surprising in a capitalist country that we have fights over the allocation of capital. And there is a fight between blue-collar families operating small businesses, pizzerias, plumbing supply operations, and Wall Street that prefers billion and multi-billion-dollar transactions. And all the decision makers are grad school educated, people wearing ties like me and you. And I won't say that the decision makers and the regulators hate the blue-collar families. They just don't feel comfortable with them. And so when we have to make a decision as to where the money goes, it doesn't go in $250,000 loans to pizzerias. It goes in multi-billion-dollar transactions on Wall Street. And I see these stress tests as pushing us further in that direction. And you can see from a bank examiner's standpoint, Silicon Valley Bank buys $50 billion worth of treasuries. Oh, that looks wonderful. Wall Street understands that. All the files are perfect. We kind of know what the credit rating is of the borrower. You actually look at the file for a $250,000 loan, it's a bit messy. Some things are handwritten. It wouldn't get you an A at any major business school. And so this capital is shown because the fight is shown by Basel III proposals that give only a 65% rate rather than a 100% rate when the borrower is a publicly traded company. But the greatest problem we have is the fight between interest rate risk and credit risk. The pizzeria loan is nothing but credit risk. The Treasury investment is nothing but interest rate risk. And so we have a system that focuses on the credit risk and deliberately ignores the credit risk, the interest rate risk. And they do it deliberately, and they do it by what I call the stupid depositor model, which is that if interest rates go up, your whole portfolio of treasuries goes down in value, but the bank makes money because it has lots of stupid depositors who will leave their money in non-interest-bearing accounts and not take it out and not put it in money markets yielding 5%. You know who turned out to be stupid? Not the depositors at Silicon Valley Bank, the bankers at Silicon Valley Bank, and the regulators of Silicon Valley Bank. So I want to ask each of our witnesses, are you aware of any stress test that focused on the risk of interest rates going up? A pretty obvious risk, because 5 years ago, interest rates were zero. They had only one way to go. Did that a stress test for interest rates going up and depositors not being stupid. Do any of our witnesses aware of any such stress test? I don't see,
So the interest rate risk, the Basel standard that I mentioned is essentially a stress of a portfolio against changes in interest rate risk, in interest rates.
But that's proposed for the future. We've had stress tests for a while.
Other countries have been doing it for 20 years almost.
But has the United States, has our regulators done a stress test looking at the very stress that was pretty obvious that interest rates would go up, having been?
That's exactly right.
We never tested.
They did not do that.
And then even worse, for Silicon Valley Bank, et cetera, two worse things. One is they didn't even have to face a stress test because they were below the limit, and the limit should have applied. And then second, to illustrate how it's not the depositors that are stupid, Silicon Valley Bank had, in effect, an insurance policy against interest rates going up and their portfolio of bonds going down. And you know what they did with that insurance policy? They sold it to generate money that could generate bonuses for their executives. I realize I've used a lot of my time. I'll just say that I don't see there's much excuse for the regulators not to publish everything after the test. You don't give away the questions before the test, but after the test. This is a democracy. Things are supposed to be public, and I yield back.
Gentleman yields. The gentleman from Missouri, Mr. Luke Tamara, is now recognized.
Thank you, Mr. Chairman. Thank our witnesses for being here today. Interesting discussion today. What's the purpose of a stress test? Mr. Campbell, what do you think the purpose of the stress test should be?
I think the purpose of the stress test should be to assess the capital adequacy of the nation's largest banks.
Okay? If you're going to assess that, wouldn't you want to know how you're going to be assessed so that you can manage your bank accordingly? I mean, that would seem to be, to me, what I would want to know.
Yes, absolutely.
So what we have here right now is a game of gotcha. If we don't have the Fed be able to give us the information that's going to be on the stress test so that we can change our model, to me, the stress test should be the Fed's own thought process of what the next crisis is going to be, what the next concern should be with regards to managing banks and our economy coming down the road. Mr. Sherman made a great point here a minute ago with regards to the interest rate risk that got Silicon Valley and several other banks. It wasn't tested for it, is that correct?
I'm sorry, I didn't quite hear you.
Okay, the stress test that Mr. Sherman was talking about with regards to interest rate risk, that wasn't on the stress tests.
Correct.
So I think it's being incorporated now, if I understand it correctly. But so they missed the future problem that they should have been able to see, as he pointed out. Everybody should know you're going to have, if their interest rates are zero down the road, you're going to see them go up. So to me, this stress test should be something that would help banks manage their future problems according to what the Fed sees those problems to be. And so the discussion then is, why do we not want to know those things ahead of time so that we can actually manage our banks? You want to wait a year before you get your stress test, before you can actually change your model so that you can minimize your risk? Does that make sense to you?
No, not generally.
Mr. Gould, what do you think about my analogies so far in my discussion? Am I on point, or am I off on this?
I think you're on point, Congressman. I would just note that I think the underlying analogy to the concept of gaming is fundamentally off, right? This is not a situation where we're testing the bank's knowledge, and so we don't want to give them the answer set. Capital, this is a compliance obligation, and we're setting capital requirements. Inherent in setting capital requirements is establishing incentives, some of the very incentives that Congressman Sherman was mentioning that have altered the nature of the banking industry and the clients and customers it serves. So I think it is very important that we know these in advance.
So to me, the argument about gaming a system is false. I think we need to be showing how this test can actually help banks manage their banks better. That's what it should be all about at the end of the day. Have a better banking system and a more sound economy, and everything's going to run much better. But anyway, Mr. Gould, you went into a lengthy discussion. I know Mr. Covas also had some comments with regards to the Administrative Procedures Act and the fact the Fed doesn't adhere to that. So if they don't adhere to the Administrative Procedures Act, that is a law, by the way. If they're not adhering to that, are they in violation of the law?
Congressman, that's for a court to decide. But certainly, I have not heard a convincing defense as to why they are not providing a notice and comment on these models.
You're an attorney, are you not?
Yes, sir.
If you were, do you advise banks with your
I
practice? Do you advise the bank to go after the Fed and sue them if they're going to try and impart this thing onto them without any going through the proper procedures? And it's in violation. It's a violation of law.
Look, I think that's an individual determination that banks have to weigh pros and cons, because as you know, banks have a lot of.
Okay, well, you were advising the American Bankers Association, or which represents most of the big banks. Would you advise them to take this to court?
Congressman, I would certainly advise them to consider it strongly.
Okay, very good. Question number 3 here. Okay, one of the things that concerns me is that we have a situation here with this proposal that the Fed's going through with stress testing, and it seems very inconsistent when you look at CECL. Here they ask the banks to be able to do their own modeling with regards to the local economy, with regards to how they should determine loan loss, and you have one bank on one side of the street, one bank on the other side of the street come up with completely different models, and that it could be okay. And so now we're talking about a stress test that goes across everybody, and they're sitting here with no ability to have an impact. And to me, whenever you have people, the reason for comment period, by the way, is to have people who actually know what they're doing in the business to be able to tell you whether it's going to work or not. Mr. Chairman, I'll yield back. My time's gone.
Gentleman yields. Gentleman from Georgia, Mr. Scott, is now recognized.
Thank you, Mr. Chairman. You know, we worked on this. I felt this was a real critical part of Dodd-Frank. And many of us on this committee were around back then and put a lot of work into it. But Mr. Feldberg, there's one piece that we've been leaving out here. There are two pieces to this, and we talked about the banks, and that's the non-banks. I want you to kind of delve into that a moment, because oftentimes we miss the real deal in solving a problem, much like we did with Dodd-Frank, and we had to call attention. I know I did with Barney Frank, and say, we can't solve this with just bailing out the banks. We've got to do something else for those people who are losing their jobs, who are losing their homes, and we came up with the hardest hit. Tell us about the non-banks. How can shock scenarios and hypothetical models be designed to best analyze the interconnections between the banks and the non-banks?
So that's a very good question, thank you. Other countries have taken a much more aggressive approach on this. The Bank of England is currently doing an exploratory analysis.
You said the Bank of England?
Yeah, of banks and non-banks.
Mm-hmm.
The U.S. has not done this yet. I think part of another aspect of Dodd-Frank was designating systemic firms that were not banks for supervision, which might have led to stress testing of those entities. But we haven't attempted that yet. There are models around the world, other central banks, the IMF, that conduct stress tests on the non-banking sector, and that's something that the U.S. ought to be doing too. It's harder when you don't have supervisory regulatory authority over an entity to involve them in a stress test.
Do you feel it is possible to build a process through which banks could replace some Fed models with their own model, subject to careful consideration and Fed approval?
So I would not recommend replacing the Fed stress test, but the banks do have their own models, and I think the existence of both Fed models and the bank's own models is a good thing to have both of those checks over the risk management of the bank.
Yeah. Now, how can federal regulators safeguard such a process against poor quality of risk management, or without sacrificing the Fed's goal of consistency across the institutions subject to stress testing? And that's particularly for the most poorly managed firms.
Mm-hmm. So there used to be a qualitative objection that the Fed raised in the stress testing process, which has been taken out in recent years. But the Federal Reserve supervisory process should allow for what you just said quite extensively. If the Fed is unhappy with an outlying bank's risk management practices, the Fed's supervisory authorities should be quite extensive for addressing that through the traditional tools.
Do you feel that we're on the right course in this? Are there any other things that we on this committee can do to make sure that never again will we have the bank failures, the collapse of our financial system? That's the whole purpose of the work we did with Dodd-Frank. Is there any more we need to do, particularly in this area that you and Yale University are doing such great work on?
So there's certainly more that can be done with non-banks. I mentioned interest rate risk management. I think part of it is keeping track of financial stability risk.
You said interest rates?
Risk management oversight.
Good, all right.
And then holding hearings like this to identify financial stability risks that, that might be overseen or might be missed by the regulators, like Congressman Foster mentioned, systemic risk.
Thank you very much, Professor.
The gentleman's time has expired. The gentleman from Texas, the chairman of the Small Business Committee, Mr. Williams.
Thank you, Chairman, and thank you all for being here today. I am from Texas. Now, the Federal Reserve stress testing scenarios can play a key role in enhancing the stability of the financial system. Annual stress test scenarios can increase the public's confidence in banks' ability to handle economic headwinds and maintains confidence in the overall U.S. banking system. However, the Federal Reserve continues to limit transparency by failing to disclose the stress test models. We've talked about that, while also denying stakeholders and the general public the opportunity to provide feedback on stress test scenarios. So greater transparency and accountability in stress tests provides all stakeholders, big and small, with the opportunity to identify flaws and suggest improvements to make the scenarios more useful and the outcomes more accurate. So, Mr. Gould, can you please elaborate on the benefits of greater transparency in stress testing and why a proper notice and comment period is important?
Yes, Congressman. So first of all, as a matter of administrative law, if this is a legislative rule, which it certainly appears to be, then the models and scenarios themselves must be disclosed and they must be subject to public comment. From a policy standpoint, public comment is really important because it actually ideally makes the ultimate work product better. Number one. Number two, it also, I think, increases credibility, in the agency that's promulgating the legislative rule. And three, it serves as an element of accountability for that agency as well.
Okay. The Fed's stress testing regime is a black box comprised of thousands of pages of complex data, formulas, and models. This complexity and lack of transparency makes it difficult for outsiders to understand how these tests work or how they can predict their own outcomes. So consequently, both banks and the public often struggle to grasp the full implications of the results. Now, the complexity of the process can lead to uncertainty and mistrust among stakeholders who rely on these tests to ensure financial stability. Mr. Covas, can you discuss how the secrecy and lack of information on the stress test scenarios makes it harder to evaluate the analytical effectiveness and accuracy of the test outcomes?
Thank you for your question. So the Fed models, because they are based on data that's not very granular, the results change significantly from one year to the next, just due to changes in banks' balance sheets and the fact that the scenarios themselves are also changing in ways that are unpredictable. Now, the results, for example, what happened during the post-pandemic, the Fed increased significantly its balance sheet, and by buying treasury securities, by the amount of $1 trillion, banks' balance sheets increased significantly with reserve balances. And according to the Federal Reserve models, the higher is your balance sheet, in particular by having higher assets, the higher are your expenses. That increases banks' capital requirements in the stress test because they are holding more reserve balances, which is F0 to no interest, non-interest expense. So as a result, the banks that need to price in the increase in capital requirements in the loans they're making to households and businesses, and as a result, that reduces credit availability and ultimately negatively impacts economic growth.
Okay, thank you. Over the last year, I've talked at length about the dangers of increasing capital requirements on banks and the impact that these changes can have on businesses' ability to access reliable credit. Now, proposals like Basel III Endgame force banks to hold more capital, which in turn increases overall borrowing costs and reduces availability of credit for businesses and consumers, in many cases right down Main Street. So this is why I'm extremely concerned with the lack of transparency surrounding stress tests, because stress tests can be used to set binding capital requirements for banks. We must ensure transparency and public engagement on stress testing to reduce any redundancies in which the capital requirements require. So, Mr. Campbell, quickly, what are the real-world impacts stress tests have on banks' capital requirements, and how does this impact the cost of credit and access to capital for businesses like mine?
Sure. So in the last couple of years, the Federal Reserve has undergone actually a massive project to formally include the stress testing process into the formal bank regulatory capital framework. So today, stress tests are run, and those result in what's been already discussed today is the stress capital buffer. The stress capital buffer is indeed a regular element of a firm's required bank capital requirement. And so after running the stress test, if their stress capital buffer goes up by, say, a full percentage point, that increases the amount of capital that they need to maintain against all of the assets on their balance sheet. And as they need to raise more capital on their balance sheet to support the assets on their balance sheet, that increases the cost of funding because bank equity capital is the most expensive form of finance. And so as they raise more capital, that raises the cost of funding. As that raises the cost of a bank's funding, for any business, it doesn't matter if you're a bank or a car dealer or a bakery, when the cost of your inputs goes up, you turn around and you have to charge the customer more. So ultimately, that's going to impact people who are borrowing from banks, and that's going to increase the interest rates that they get charged on loans.
I don't raise the cost of my cars.
The gentleman's time has expired. The gentleman from Texas, the other gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. Thank the ranking member. Thank the witnesses for appearing. I'd like for Mr. Feldberg to respond, please. Sir, if we make the banks aware of what we're testing, would that encourage them to be prepared for things that are not being tested, such that they would not take into consideration some of the many other concerns that may hurt us when we have a downturn? Let's turn the speaker on, please.
So could you rephrase that?
Yes, I'm simply saying that if the banks are aware, they know what the testing's all about, I'm confident they would be preparing for this. But what about the many other things that they might avoid or not prepare themselves for because they focused only on what they are concerned with in terms of passing a test? Your response, please.
Yeah, no, I think that's a fair point. And I think, some disclosure, the Fed discloses quite a lot, as I pointed out, and I really think I really want to emphasize that point. The Fed discloses a lot about the stress test methodology, more than any other country. And to some extent, that's a good thing. And I think the argument I was making was that at some point, you're providing so much data that all they're doing is optimizing to the test.
Exactly.
And it's diluting the point of the exercise. And former Vice Chair of Supervision, Dan Tarullo, who was the leader who led the stress test process through much of the first 5 or 10 years that it was run, has expressed concern about the excessive disclosures that are already being made to some extent, and that could be made under what's been contemplated. And he's made the argument that if you're really going to go this far, and what I would call just make it like the OFEO process that had such dire results with the GSEs, you might want to just consider something else. And it was kind of shocking to read Dan Tarullo's paper in Brookings just a month or two ago, where he said, at this point, maybe we should just take away the connection of the stress test to capital, because if we're going to go ahead and make it this predictable and easy to game, then really maybe we just need another tool. It was very distressing to see him say that. But he laid out, what it would look like if we were going to decouple it from capital.
And if we should decouple, what is that other tool?
So in his view, if you were going to say, and I think it should be pointed out that other countries that do stress testing do not tie it as directly to capital as we do. So essentially, you'd just be looking like other countries. It would be an exploratory scenario that would help the regulators, inform the regulators on what the capital charges would be for individual banks. That, of course, the way it works in other countries, would probably raise even more objections as far as transparency. If you look at Bank of England, any country, they conduct a stress test, and they say this informs our individual capital charge for that bank. So essentially, that's more of a black box than we're talking about here. So I don't think the banks are going to want to see that alternative. Whatever you do, Tarullo made the point that if you're going to get rid of the stress test and its impact on bank capital, you're going to have to raise the basic level of capital before the stress test, just because you've gotten rid of all that sensitivity and analysis and its role in the capital process.
Thank you, Mr. Chairman. I yield back the balance of the time.
Gentleman yields. The gentleman from Tennessee, Mr. Rose, is recognized.
Thank you, Chairman Barr, and thank you to our witnesses and also Ranking Member Lynch for holding the hearing today. Mr. Covas, in your testimony, you highlight that the reconsideration process, so stress tests, are inadequate. Is inadequate. Could you elaborate as to why you believe that?
Thank you for your question. Yes, so since the stress capital buffer framework was put in place in 2020, we have had 8 reconsideration requests for which the Fed has effectively denied those requests. However, we don't know, to the best of my knowledge, there's been no change in adjustments in the stress capital buffer of those banks, and there's no explanation of how those reconsideration requests are currently being addressed in terms of change in the models and any timelines and how they are addressing the shortcomings of the models that have been pointed out by the firms.
So it's truly a black box out of which the...
Yes, it's very difficult to understand how the results change from one year to next, despite some of the disclosures. I've been following the stress test for some time. It's always whenever we get the results and compare against our expectations, it's very difficult to know exactly how the results change from one year to the next.
And has there ever been a situation where the Federal Reserve has admitted fault and revised the stress capital buffer for a financial institution that appealed?
To the best of my knowledge, no.
Okay. And how would establishing a truly independent review mechanism with clear procedures and timelines solve the problems with the reconsideration process, in your opinion?
So forcing having much more transparency around the process is going to force the Federal Reserve to just disclose a lot more information for the public and for the firms themselves that can analyze. So just, for example, notice and comment on the models would address many of the questions the banks have in terms of the behavior of the models. And if they still disagree of the relationships, they can, again, through the notice and comments process, try to improve the models. At the same time, this does not is going to obligate the Fed to actually follow the comments provided by the industry. The Fed could always deny and not follow those. So I do think it's important to have a third-party validator that just reviews this interchange of information between the commenters and the Fed and provides recommendations. A good example would be the GAO to perform that role.
And as a recovering lawyer, the failure to solicit public comment on stress models and scenarios appears to violate administrative law. Your thoughts on that?
So coming from an economist, the SCB is effectively the capital requirement, no different from the Basel capital requirements that we've been discussing over the past year. So there are rules that affect banks' decisions in terms of capital allocation. So yes, I do think they should be subject to the same requirements as the Basel Endgame proposal, for example.
And Mr. Gould, I know that you share these concerns as well. Have the courts reached any conclusions as to whether models treated by agencies as binding must go through public comment?
Yes, they have, and the courts have concluded that models that are treated as binding by the agencies are subject to the public notice and comment.
And you think that would be appropriate here?
It would seem to me, again, I have not heard from the Fed any justification for an exception to the legislative rule process.
And you have also described the action of the Federal Reserve as appearing arbitrary and capricious. Can you explain why the Federal Reserve might appear that way due to its failure to disclose its models?
Yes, and I think this could come up too in the kind of reconsideration process because the Fed has not provided transparency around its models. It's very hard for them to fully explain how they arrived at the outputs to those models.
Thank you. I appreciate that. As a former bank board member, I've witnessed firsthand how regulation can be burdensome and ineffective. Mr. Campbell, do you think that stress tests are useful for banks and supervisors?
I think they have the potential and the scope to be useful for banks and supervisors. I think the current implementation and the lack of transparency limits their usefulness considerably, and improved transparency would improve the extent to which they can be useful to banks and supervisors.
And what are some realistic changes that would provide immediate benefits to both the banks and supervisors, in your view?
So as we've already discussed today, greater transparency on the implementation and the specification of the stress test models themselves, as well as greater transparency on the scenario generation process, I think would help to foster greater understanding amongst banks, amongst the public, and amongst regulators as to exactly how the models work, how they're risk ranking different activities that are sitting on banks' balance sheets, and would help improve capital management decisions and understanding of the banking sector more broadly.
Thank you. I see my time's expired. Thank you, witnesses, and I yield back.
Gentleman yields. Gentleman from California, Mr. Vargas is recognized.
Thank you very much, Mr. Chairman. First of all, I'd like to say that I think this has been an excellent hearing, and I'm not exactly sure what side I fall on now, and a little more agnostic, I think, to this issue. I do see both sides, to be frank. I mean, I took a lot of tests in my life. If I had, the questions prior to the test, I think I would have done better on some. But I do agree with Mr. Sherman. After the test is over, I don't understand why it's not disclosed completely. I don't understand that aspect of it, to be frank. So I'm not sure. Whether it conforms to the APA or any other rules, I'm not sure. For years here, I kept hearing how the CFPB, their funding source, did not conform to the law, and of course, the Supreme Court came down quite clearly and said, of course it does. It's right down the middle. It's no big deal. So I'm not sure here either if it does or doesn't. I know that you have some stronger opinions here. But I do want to, and I always ask this question, so I'm going to ask it of you. I think it'd be unfair if I didn't. How many of you believe in climate change? The climate is changing. Okay, all of you, and I appreciate that. In a reasonable group like this, I would think that you'd come up with that reasonable answer, and we did. And I do want to ask about that because I do think that that's a risk that we aren't looking at strongly enough and transparently enough, frankly. And I know that the SEC now has taken a look at this, and I know the Fed is looking at it. They've conducted a pilot project on this program. And I wanted to tell you, I believe climate change is real, and we've seen things in my own district. I represent San Diego. We had a 1,000-year event. We had one of those 50 years ago. Not even 50 years, 20 years ago, and it's another 1,000-year event. It's not a 1,000-year event if it happens every 20 years. So obviously the climate is changing, and I want to know if these stress tests that we have are in fact taking into that account. But it's hard to know if we don't know what they're. Would someone like to comment on that? Yes, go ahead, sir.
I mean, I think the long-term changes in climate are just way beyond the time frame of the typical stress test. But even having said that, the climate stress scenario that the Federal Reserve just conducted, I think, was extremely useful in understanding these risks. And some of those risks really should show up in the next in the planning period for a stress test.
Well, I don't know that they're way beyond the time limit. I mean, you see all the things that are happening now, and in fact, examples, you have data gaps right now in real estate exposures, you have insurance and infrastructure exposures. The bank's financings, I'm not sure that it's not within the scope and timing of these tests.
So,
could you comment on that?
So, I mean, I think to the extent that a bank is experiencing, has real estate on the coast and is experiencing borrowers whose insurance rates are going up, and that's affecting their credit risk, we shouldn't even be talking about climate scenarios. That should already be in their credit risk analysis. I mean, there shouldn't be anything controversial about that.
I don't think there should be. Would anyone disagree with that? Yes. Would anyone disagree with that it already should be in the models?
I think to the extent that climate risk is approximate in first order risk on bank balance sheets, then it should be included in the models. I think there's an open question as to whether or not climate risk is a first order imminent risk in the banking sector that would have material consequences to the banking sector. I think the available evidence and research suggests that it's not. To Greg's point, especially over the time horizons over which we think capital is a useful economic resource, it's not clear that climate risk is a first order issue. But to the extent that it is an important economic risk, then it should be captured in any risk model.
Anyone disagree with that? I mean, that seems reasonable to me. I mean, I would disagree that it's not. I think it is, but reasonable people can disagree. That's why it should be tested. It should be looked at. The information, the data should be there.
I mean, the insurability of coastal areas is already in question. I mean, this is happening now. It's that part is happening now. The harder question, which the Fed also tested for, is the transition risk. And that's the risk, very simply, of what happens when policy really finally transitions, if it does. So they tested net zero 2050, and the idea is somehow the global community is going to agree that we need to do whatever it takes to get to net zero 2050. And what does that mean for the financial system? And that's not going to happen in the next 24 months, but it's a serious risk that bankers should be considering.
I've got 10 seconds, so I'm just going to say I agree with what has been said here. I think it's been a very good hearing, and I appreciate it. And I think it is important that this information, the stress test information, be disclosed at some point. Thank you.
The gentleman from Illinois, Mr. Caston, is recognized.
I didn't expect to go so soon, but thank you, and great minds are thinking alike with Mr. Vargas here. I want to follow up on this climate risk thread, and I guess I'm going to start with you, Mr. Campbell, since your clients are the GSIBs who were all exposed to these stress tests. Broadly speaking, and tell me if I'm missing anything, if I'm a GSIB, I have a risk on my balance sheet, I can either, to the extent I want to hold it and it's insurable, I can insure it and I can offload that risk onto an insurance company. To the extent I have a buyer and I can offload it, I can sell it, or I suppose I can write it off. Is there any other, if I don't want to hold the risk, do I have any other options, or have I accurately captured all the choices I've got?
If you don't want to hold it,
If I don't want to hold the risk, I can either insure it, sell it, or write it off.
some combination of that sounds right to me, yeah.
Okay. So I asked the question because the characterization that climate risks are not, near-term risks, I think sits a little awkwardly with the reality that we have actually seen lots of data that the more likely you are to hold a mortgage in a flood-prone area, the more likely you are to sell off that mortgage to Fannie and Freddie, which is path one. We've seen a whole bunch of areas of can we get insurance. We've seen Fannie and Freddie move to, are the reinsurance markets there, which we can insure it. And then, of course, we've got these reports of, there's been stories about people in Texas and Florida who are now just sitting on uninsured homes where they're essentially writing it off, right? So the risk is there, and I think the question is not so much do the banks perceive the risk, as much as are the banks able to offload that risk into some other part of the financial system? And so if we agree that they have the risk, then I guess I'll pivot to you, Mr. Feldberg. Do you think that FSOC has the ability, authority, talent to identify where that risk is pooling in our financial system?
So I think FSOC certainly has the responsibility to do it. A lot of what you're talking about means the insurance sector, which is still state regulated in the U.S. The state regulators sit on FSOC, so to that extent, the FSOC could raise the issue with insurance, and it really is an issue that has to be looked at in terms of banks and insurance companies at the same time.
I mean, I get concerned
because of the interconnections between them on this issue.
My wife is in the insurance industry, and she has no obligation to provide insurance in every state in the country.
That's right.
Right, and so I get nervous that doesn't eliminate the risk, and we're seeing it pool up in those other places. Mm-hmm. And I raise all that because I think this question about transparency, I share I share my Jesuit friend's agnosticism. I've never met a buyer who doesn't want transparency, and I've never met a seller who wants transparency, right? And so if we were to go and identify all of these risks, and let's say we're sitting there and we say there are risks in this society, and by the way, maybe there is some of these climate risk that's held by the GSIBs, which is not insurable, which the buyer is sufficiently informed that they don't want to buy it at a price you're willing to sell. Should we publicize that? Are we on board for transparency in that case? Or does that risk jeopardizing the solvency of the GSIBs because they now are sitting on risk rather than being able to offload that into some other part of the economy that's not subject to stress tests? Does anybody have any thought? What should we do in that case? Should we make this information public, or should we punt it to a future Congress?
So that's a good question. I think we've been talking about the disclosure of the inputs into the process. Now you're bringing up the disclosure of the outputs of the process, which there's also trade-offs, like I mentioned in my paper there. You certainly want the disclosures about stress test results to be informative to the public, but you also don't want them to raise undue concern about individual institutions. It's part of the supervisory process, which has been a very confidential process since it was started 150 years ago. And certainly information like that, you might not want that to be public.
Well, if any of you have thoughts to continue the conversation, there was this study out of Harvard that I think was in a recent Senate hearing, that they found that real estate in the U.S. may be overvalued by as much as $237 billion because there's sort of second-tier rating agencies that are providing insurance for second-tier banks that are therefore able to offload this onto Fannie and Freddie. And I get it, right? Like, if there's a sucker who's willing to buy something from me, I'll sell. But all of us, whether as regulators or legislators, are ultimately going to have to fix that. And I think I'll close where I started. These climate risks are big and they are real and they are now, but we need to do stress testing of the whole financial system, not just of the six biggest banks. Yield back.
Gentleman yields. Gentlewoman from California, Mrs. Kim.
Thank you, Chairman Barr, and I want to thank the witnesses for joining us today. I'm all for ensuring the stability of our financial system. However, when we talk to small businesses and households, we should also be frank and transparent about how increasing capital requirements and making models and scenarios less predictable can reduce lending and access to capital. First question to you, Mr. Campbell. If the Fed decides to broaden the scope of stress test scenarios without making them more transparent, can you elaborate on how this decision could change stress capital buffer requirements?
Sure. So you have in mind the idea that the Federal Reserve would use more in different kinds of scenarios rather than a single scenario, just to make sure I understand the question.
To me, it seems that it could make them less predictable. So if multiple stress test scenarios make capital requirements less predictable, how can that influence lending to small businesses and families? And I ask this because my fear is that with high interest rates, mortgages, and other financial tools, that will increase in cost due to unpredictability of stress tests. So, Mr. Covas, do you have anything to add to this question?
Sorry, if you increase uncertainty regarding stress test results, the banks will want to hold more capital as a precautionary buffer. As I said earlier, no bank wants to be below their minimums by the time the requirements go live. So yes, they will reduce credit availability and provision of capital to markets.
Thank you. We understand that Basel III Endgame proposal would increase the capital banks must hold with respect to market risk. And this is the same risk that is being stress tested in the global market shock component. And I would say that this sounds like double counting of these risks to me. I know Chairman Barr touched on the double counting aspect. So if you could tweak either the market risk component of the Basel III proposal or the global market shock component, which one of the two components do you find less necessary? And would you eliminate one or both?
I mean, I can answer.
Mr. Covas?
I mean, we were disappointed, in terms of the Basel proposal. You want to look holistically about requirements and look at the requirements at the product level and see which ones are in excess. I think you want to adjust both of the requirements potentially. So the existing market risk framework has some flaws for which the Fed, through the stress tests, has ameliorated some of those flaws through the global market shock. The new proposal fixes some of those flaws. So I do think you ought to go back to the global market shock and make some adjustments so that ultimately you are not overcapitalizing for market risk.
Mr. Campbell, could you add to that, please?
I mean, I would broadly agree with that sentiment, and I think the most important thing to ensure is that the global market shock and the treatment of market risk assets in the context of Basel III Endgame work in a conceptually consistent and logical manner, and that they don't basically work at cross purposes with each other, and I think that's part of what's going on in the current regime.
Well, let me move on to another matter. It's been suggested that being more transparent with models and scenarios could lead to gaming, and that it could be like the teacher revealing the questions to the students before the exam. So, Mr. Covas, do you think the Federal Reserve Board revealing methodologies and increasing public engagement on the stress test framework would lead to banks gaming the stress test?
As we discussed in the hearing, no. I mean, again, this is the stress test, our capital rule. The banks need to do portfolio allocation of capital through the different products they offer. They need to know what the capital requirement is. Banks change their portfolios driven by business decisions and market demand, not because they want to game or reduce the capital charge in the stress tests. The models, if they are accurate, the banks have no incentive to game accurate models, and if they are inaccurate, they should be put out for notice and comment to fix the models. Finally, the Fed already has processes in place to look at banks' exposures and through the global market shock, and they can disallow exposure. They've been doing that for the last at least 3 or 4 years, where they look carefully at banks' exposures. And if they think some of the exposures are just to reduce the charge in the stress test, they are disallowed. So,
Mr. Campbell, on the same topic, can you explain why it's difficult to game stress test when you're talking about hundreds of billions in the balance sheet of a bank?
Sure. So I think this notion of gaming the stress test is largely a misnomer. And what banks are doing is they're using the information that they have access to in the risk weights, in the context of things like the GSIB capital surcharge, and in principle, in the context of the stress test, to assess the riskiness of the assets on their balance sheet, and then make funding decisions on a relative basis in concert with the other information that they bring to the table in the context of their own risk management decisions. And the better information that they have access to, the more complete that information, the better a risk management decision that they can make. To the extent, as Francisco and others have pointed out, to the extent that the Federal Reserve is concerned about some sort of gaming activities or something else, they have a variety of remedies at their disposal that they can use through the supervisory process to deal with that. They do not need to limit the transparency in the stress testing regime to deal with that issue.
Gentleman's time has expired. Gentlewoman's time has expired. The gentlelady from Massachusetts, Ms. Presley, is now recognized, and this will be the last witness of the last questioner of the hearing.
Thank you, Mr. Chair, and thank you to our witnesses for joining us today. The 2008 financial crisis exposed the weaknesses and vulnerabilities in our financial system, causing a recession that robbed an entire generation of economic opportunity, and many are still reeling from these effects. The modern stress testing regime that regulators use today was born out of that crisis and is now a staple of our regulatory framework and oversight of banks. My Republican colleagues, however, want to go beyond the rollback of Dodd-Frank in 2018 that directly led to the collapse of SVB and other banks last year. They want to continue down a path of deregulation that will undoubtedly increase systemic risk in our financial system and increase economic harm to our constituents. Make it make sense. Mr. Feldberg, how did regular stress testing restore confidence in the banking sector following 2008 financial crisis?
So in the middle of the financial crisis, there was widespread concern about the capital of all the largest banks in the U.S. I think there was just a lack of belief in regulatory capital information that was out there. There was a lack of confidence in the measure of capital. So the point of the stress test was to throw a very difficult scenario at the banks and to ask the question, what would happen if this thing even got even worse than it is? I think it was seen as a very credible test. The important thing really was that it be seen as credible by the markets. And the results showed some banks pass, some banks fail. Banks went ahead and raised capital in an environment in which confidence was improving. I guess there was some luck that they were able to raise capital, and only a small number of banks ended up really failing the test. But it was a remarkable opportunity to address a crisis and get it going, and get things going again.
Thank you. Again, deregulation is a failed approach. Yet bank lobbyists are continuing to push for less stringent oversight. My colleagues across the aisle are working with big banks to publicly reveal the mechanics behind stress testing. This is not a pro-transparency, good governance argument. They simply want to help banks game the system and circumvent oversight. Mr. Feldberg, in 2019, the Fed provided details to banks about how they conduct stress tests, and this diminished the value of those tests. If the Fed reveals even more information, just building upon what we've been talking about today, please expound. Wouldn't that allow banks to game the tests, undermining the very purpose of examining how resilient and prepared banks are for unexpected shocks to the financial system?
The banks spend a great deal of money trying to reverse engineer the stress test, and don't think they do that for any other reason than trying to game the process. They can already do a pretty good job of reverse engineering because they already get more information about the stress test models than any other country gives their banks. If they got what's being asked for today, it would emasculate the process, and we'd have something similar to what OFEO had with the GSEs, an ineffective process that doesn't keep up with changes in the financial system.
Thank you.
Just an argument that came up earlier was, why don't we reveal these things after the test? And I would discourage that idea from going much further. As I keep on saying, we actually do disclose a great deal already. So the difference in what we would be disclosing after and before the release of the results isn't very much, but it is that one little secret sauce that prevents the banks from essentially just replicating the models and baking grandma's cake, and then you've got no, you don't have a test anymore.
Thank you. When implementing stress tests, regulators should be prioritizing what is best for consumers and the stability of our financial system, not the desires of greedy bank CEOs. If Republicans and big banks want greater transparency, then they should practice what they preach. I have a long list of areas where banks should be more transparent. The use of AI in decision-making, their investments in mass incarceration, the funding of fossil fuel projects that kill our environment, the denials of mortgages and business loans to disproportionately Black and brown communities, and so much more. The Fed should not give away the answer key to stress testing. After witnessing some of the largest bank failures in our history last year, our response cannot be further deregulation that weakens our banking system. We need meaningful and stringent stress tests for a safer and more stable financial system. Thank you. I yield.
The gentlelady yields, and I'd like to thank our witnesses for their testimony today. And as a matter of a concluding observation, I would just say that I thought we had great testimony, great points made by all of our witnesses, and my takeaway is that we can have more transparency in stress testing. We can reduce the opacity, and we can do that certainly on the input side of things to provide the accountability, to improve the process, to improve the actual stress testing itself. And we don't have to do it in a way that would create the risks that Mr. Feldman pointed out on the outputs. I think he makes a good point that the goal should be to reveal just enough about banks to help market participants evaluate risk, but not so much to undermine confidence. I think improving transparency at the front end doesn't necessarily have to lead to undermining confidence on the back end, and results of stress tests can be disclosed to the supervised institution so that they can evaluate those risks without undermining confidence. So with that, I appreciate the testimony. I think this was a great hearing. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is now adjourned.